What a stupendous market move it's been. Friday, second half onwards. We are talking about 19,600 on the benchmarks. Clearly, large cap, which were kind of sideways for the entire August series, seem to be coming back. But mid cap party is not over yet. But is it time to be slightly cautious at these levels? This is the first question I'm going to pose with Jyoti Jaipuria, who's joining us now on the show. Jyoti, afternoon. Are you grappling with this question as well? This issue that your portfolio, especially in the broader markets, may be doing phenomenally well, but valuations are getting stretched and you are getting an urge to start trimming in some areas.
Yes, Ajay. So that's been like the issue, right? All of us are happy when the market goes up, but at some point, with valuation being what it is, I'm hoping that we get a phase of consolidation in the market so that valuations can get some time correction and have a breather. So probably a few months down the road, we start feeling comfortable of the markets again. To be fair, like the last 6-7 weeks in the large caps at least has seen some time correction. We are probably like a bit of price correction, more of time correction. So we become probably 2-3% cheaper than what we were a couple of months ago. But the small and mid cap of the frenzy just continues.
One second. Right. Jyoti, which are the areas of the market which you will certainly look at adding if the market does give their opportunity of scaling back? Something which you have on your radar, but you wouldn't add right now, but only on pullback.
Ajay, like there have been 2-3 themes we've had since, last 18 months, and we continue to be positive on some of them. So one has been, buy local and avoid the global. Second has been within local, we prefer the investment plays over the consumption plays. And third has been we prefer stocks which are basically been gainers from the pullback in commodity prices where margins have taken a big tumble. So these are three themes which we continue to like, we'll continue to play. Having said that, there are a couple of things which we've added. So one has been pharma. So in the last 4-5 months, we've added substantially to pharma because my thought is that we are probably seeing a bottoming up of the US generics price decline. They're starting to plateau now. They're probably not really going up in terms of prices, but at least all the fall has got arrested. So to that extent, they'll not contribute negatively. Now, one other thing which I guess all of us are looking to is this software. And do we buy software? At what price we buy software? It's come on our screens because it's cheaper than what it was. It's underperformed for a long time. I'm hoping we get some bad news there. So if we get some bad news in, let's say, this quarter results or next quarter results, I think, we may, press the button at that time and buy these stocks.
Jyoti, I want to ask you a question based on your rich experience in the market. What are those signs beyond valuations which tell you that even if your positions are hugely profitable, somewhere you have to start taking profit? Beyond valuations, what are those signs of the ecosystem which start telling you that maybe people are starting to get complacent in mid cap, small cap, maybe things are getting stretched?
Yeah, so Ajay, the whole thing is valuations can be high for a long time or they can be low for a long time. So from our point of view, when we think about it, what we think is the core earnings growth starting to slow? Is it starting to peak off? And if that earnings start to peak off, then you have to be very careful because at some point you get earnings which start slowing and the valuations also come down very, very quickly. So you get a double whammy because those don't play out. So for us, it has been most of the stocks, we always think of the risk reward. We think what is the margin of safety for us. And for like I can tell in some of our stocks, we own a lot of these capital good names. And we were very early into it. So to that extent, we made a lot of money on it. So from here now, the valuations are such that you need the earnings growth to continue at a pace. At some point, if the earnings start to flag for whatever reason, government has maybe spent upfront in the budget. And so second half of the fiscal, we start seeing government cutting back on the capex expenditure. Then these stocks are not now priced for any bad news. They can't withstand a bad news. Whether the good news continues, you probably get now earnings growth sort of returns in there. So for us, it is, do we trim a lot of these stocks? Do we get into something like a technology which is done badly where expectations have come down quite a bit? These are some of the things which we have to grapple on. And for us, I think more than the valuation, the decisive thing will be, do we start seeing some of these things flagging off, or the good times for the Indian economy continue?
So IT and pharma are the areas which you like right now, and maybe on pullbacks too. Uh, what are the other global focusing sectors? Metals. Have you started looking at metals? If indeed U.S. market doesn't see economy doesn't see a hard landing, it's a soft landing, and things start improving. Would you look at metals, or you'll stay away because of the China issue?
So for me, like metals is something which we're staying away on generally. And like, if you just step back and think, like everyone talks of the US recession. So we were all hoping US slowdown, US recession for this year, which has not come. But if you ask me for the next 3 years, I think the big risk is not the US. The big risk is China. I think China is perceptibly slowing down, and that will have a secular slowdown in growth because they probably overbuilt the infrastructure. And now they have to go through a phase where that whole overbuilt infrastructure, which drove all the GDP growth for the last many years, is going to start hurting them. So I think China is going to be slower for longer in terms of GDP growth. So if you ask me, like just on an overall macro, I think the big story is China. It's like a probably negative for India to some extent, but it's a positive to a large extent also. And how India navigates this, vacuum of China will probably determine how well we do, like on a 5-year basis.
Jyoti, you said that you got into capital goods pretty early. What are your thoughts on power value chain? The entire generation companies, both legacy and renewable, transmission towers, and all of that. Uh, do you have them in your portfolio? Would you play that side of the market, or expensive?
The way we are playing it is, they obviously like the whole move is towards renewables, right? So for us, there are two ways to play this. We can play the renewable companies, or we can play what I call the ancillaries to the renewable companies. So, you can buy some of the crane sort of companies which will supply, to the solar people, or you can buy some of the equipment suppliers, or you can buy the transmission. So we prefer playing it through the ancillaries rather than from the power generation companies directly. So even if some of these companies do well, the others don't will do well on the generation side, all the equipment suppliers, the ancillary to these guys will do well. And that's been our thesis that, we may not be able to call who's the winner in the whole renewable race. But as long as somebody wins and as long as the overall market expands, our companies which are suppliers to them will all do well.
Jyoti, also, there was a very interesting note by Morgan Stanley just yesterday saying there's a case building for a strong pre-election rally. I want to understand historically, pre-election years, how does the market behave going into the actual election announcement? How is the setup of the market looking this time? Expectations that continuity, etc. Any thoughts there?
So, generally without getting too much into politics, for the market, most of the time they like continuity. That, okay, if there's like a continuity in the government, then we would like it. What the market does not like is all these shocks. So, I guess if we go back to 2004, on that election day when, the government changed, the market fell 15%. But when the same government came back in 2009, the market went up 20%. So, to that extent, and we've done like a long analysis of, markets versus with political parties. Our views, there's no real difference in stock market performance between any of the political formations. So most of the political formations, the markets are more or less, they've been good in all of them. Uh, but like I said, generally they don't like change. So basically, going into elections this year, for the market, it is the general expectation is that the same sort of government will be formed again. There'll be a continuity in political formation, and that's what the market is expecting and priming for. So if that narrative gets shaken, then at some point, the markets get nervous. Not because they have a strong view that, okay, this government is better than the other, but it's just, we like policy continuity. We like, politics to be on the sidelines so that we can focus on economics and we can focus on earnings.
How are the global risks looking right now? China, US, even Europe, or things appear under control?
So, like if we look at the three pockets, like I said, I think the area where the economy is probably looking the most dangerous is, China. because that is an economy where they need to really pump prime, and like the real estate sector in China is probably going to struggle. All the infrastructure sectors in China are going to struggle. So that's where I think, we have the biggest pain in terms of the global economy. Europe and US have done surprisingly well. In spite of the series of Fed hikes we have seen, they've not really, had that big slowdown which everybody was fearful of at the beginning of the year. Maybe that slowdown has just got postponed and we'll see it coming next year. But still, amongst the three belts, I would say that China is where the biggest concern is. They will lead to, China accounted for like 40% of global growth for the last 20 years. So, to that extent, when that slows down, global growth is going to slow down. And that on the margin may impact India also. But I think the impact for India is in some sense positive, because one is there's a China plus one, and a lot of people are looking at India to fill up the vacuum of China. Second is from the stock market point of view, China has like 30% weight in the MSCI Emerging Market Index. India is like 14. So, if as people move a bit of their money away from China because they think that's like secularly going to slow down, India is probably one of the economies which will start gaining benefit from that, because we are into an economy where, hopefully we are probably over the next 3 years, 4 years, one of the best performing economies in the world. So probably secularly we'll see money flowing from China into India on the stock market side, as well as on the manufacturing FDI side.
All right. I will let you go on that one, Jyoti. Wonderful chatting with you.